3 stocks, the June 2019 edition. Let's get started. What's up, everybody? My name is Ale and welcome to my world of stocks. I know you guys like timestamps. I left them for you down below on a pinned comment and in the description. All I ask is that you please hit the like button if you're enjoying the channel. It really helps support it and I really appreciate it. And in case you're new to the channel, this is the monthly series where I try to give you a bullish long-term thesis on 3 different stocks every month. It's not an easy thing to do, so please do your own research and make your own decisions. I'm not telling you to buy or sell anything or that these stocks will magically go up within the next month. I'm just kind of trying to give you a long-term bullish outlook. Also, with the whole trade war going on between the US and China and economic slowdowns overseas, I would not be surprised if the market continues to be very volatile this year and we see some lower prices on all the stocks I talk about today and in any other videos as well. So in today's video, I want to give you guys 2 stocks that I think are have very limited exposure to China, which is a good thing for them, and they do also have a lot of long-term potential as well. And then with stock number 3, it's actually going to be a much higher risk stock that a lot of you are asking me to talk about, and it does have exposure to China as well, so it's probably going to struggle here in the short term, but they do still have a lot of long-term potential. So anyway, this should be a very fun video. Let's go ahead and start with stock number 1. Okay guys, starting with stock number 1, we're going to go with Cisco, ticker symbol CSCO, and this is a very interesting stock, very interesting company as well. And the reason why I like this stock right now is because they still have a pretty decent valuation despite being absolutely on fire lately. Like, this stock has really climbed a lot, but they still have a pretty reasonable valuation. They pay out a very nice dividend, and management has done a tremendous job of limiting their dependency on China, which is also a really good thing. Now, if you've never heard of them, they're mostly a networking hardware, software, and services company that mostly sells routers and switches, but also deals in wireless infrastructure, data center products, and even security services. They're also a huge play on a new Wi-Fi technology called Wi-Fi 6 that is often said to have very similar revolutionary traits to that of 5G. Obviously not the same as 5G, but kind of similar in some aspects, in that it will allow many more devices to connect to a single access point with faster data speeds and quicker response times. But speaking of 5G, Cisco remains a big play on that as well, given that they offer several different 5G solutions, including their multi-cloud to client network architecture. Not to mention that China's Huawei, which I always pronounce incorrectly, but China's Huawei is one of the biggest networking companies in the world, and the latest attacks on it from President Trump could leave the door wide open for smaller competitors like Ericsson, Nokia, and more importantly Cisco to step in and steal a ton of customers who look to build out their 5G network infrastructure, applications, capabilities, and services. This could potentially translate to brand new customers for Cisco, who they can not only sell their Wi-Fi and 5G equipment and services to, but they can also stack on various other hardware, software, and even security solutions as well, essentially giving them access to new revenue streams across their entire business if they can market them effectively. Now, when looking at the stock, it's up over 130% in the past 5 years, so it's been absolutely on fire. And most recently, they've reached new highs, already climbing by almost 30% so far in 2019 alone. They also just reported phenomenal earnings that sent the stock shooting up another 7% in the last couple of days. And while I'm definitely not eager to buy at these higher levels, given that I usually do most of my buying when stocks are actually going down, Cisco has still caught my attention, because even at these levels, they're still trading at just about a 16 forward PE ratio, yet they're doing nearly $50 billion in yearly sales with growth rates of about 6 to 8% in the last 4 quarters, with their latest quarter bringing in about $13 billion. That's pretty impressive considering the slow growth nature of router and switch sales, but recent increases in demand due to enterprise customers upgrading their networks has resulted in very positive results. In fact, what's most impressive about Cisco is probably their earnings growth that saw adjusted EPS consistently climb by double digits in each of the last 4 quarters, with the latest quarter bringing in as much as $3.5 billion of adjusted net income. That earnings growth is crucial when you're paying out a growing dividend that still yields about 2.5% and carries a very nice 20% 5-year growth rate. They also have a pretty reasonable payout ratio under 50%, and while it only has about 8 years of growth, that was actually when they started paying the dividend, so it's really grown every single year since they started paying it. And that's not the only way that they return profits to shareholders. In fact, they continue to boost their EPS numbers by buying back a large number of shares. In their latest quarter, they repurchased $6 billion worth of stock and still have another $18 billion remaining. For context, their market cap is only around $248 billion, which means that the most recent buyback program could take another 7% of those shares even at these higher levels. In any case, I'm inclined to believe that the growth can continue for Cisco, even with the whole trade war going on, given that they guided for sales to increase next quarter by 4.5 to 6.5%, which is well above the 3.5% that Wall Street was looking for. By the way, the high range of that would absolutely crush those expectations. And a big reason for the surprise is that Wall Street was expecting the trade war to have a bigger impact on Cisco's guidance, but during the conference call, they stated that they've already done everything that they need to do to deal with those tariffs so that they have a very minimal impact on sales. And they went on to say that everything is already absolutely baked into their guidance going forward. By the way, they've done so much work in shifting their supply chain that they're now dependent on China for only about 3% of their sales, according to a recent interview with Market Watch. They also have a pretty good balance sheet with around $47 billion in current assets that covers both their current liabilities and their long-term debt, and leaves them with a current and total ratio of 1.68 and 1.62 respectively. So again, couple the decent valuation, even despite the huge run-up in price, with the future growth prospects of Wi-Fi 6 and 5G, and very nice growing dividend, and the limited exposure to China that they continue to improve, and I think you got one heck of a stock here. So Cisco is definitely one that I'm keeping a close eye on. It's not one that I've purchased yet, but it is one that definitely has my attention and that I do kind of like for the long term. Alright guys, moving on to stock number 2, we'll continue the trend here with limited exposure to China and, very little risk in my opinion. This one, definitely very little risk. It's one of my favorite stocks out there that I do not currently own, but I definitely want to buy soon, and that is of course Google, ticker symbol GOOGL. And Google is obviously much more of a software and services company, so tariffs aren't really going to impact them, especially since they don't really have much exposure in China anyway, but we'll talk about that a little bit later in the video. Now, taking a closer look at the stock, you can see that they're still up by over 100% in the past 5 years, and we're having a great start to 2019 before taking a hit on earnings day that sent the stock down to near the midpoint of their 52-week range, which is a big deal for a stock like Google because we don't normally see decent discounts on Google, but right now you can pretty much get it about the midpoint of the 52-week range. In my opinion, that's a pretty decent discount for a stock like Google. In any case, the drop now gives them a forward PE ratio of 21, and for a stock like Google, I think that's very attractive. Now, the drop mostly had to do with sales coming in lower this last quarter by about $1 billion versus their expectations, but they were still technically up year over year by 17%, and they also beat expectations on adjusted EPS. But the revenue growth rate of 17% was lower than the 23% that they saw a year earlier, so Wall Street took that as a sign of Google's business slowing down, mostly in online advertising, which we'll look at in a second. Still, in my opinion, it was all blown way out of proportion, given that they lost over $60 billion in market cap, yet their free cash flow actually increased by a massive 70%, coming in at over $7.3 billion, which, by the way, I saw almost no reports even bother to mention. But taking a closer look at their ad sales, which is really the primary source of the revenue, its growth slowed down to about 15% versus the prior year coming in at 24%. So that's a pretty big decrease there in growth. Still, Google has been the leader in digital advertising for a long time now, so a slowdown in growth given the rise in competition from Amazon, who is outpacing both Google and Facebook at this point, isn't really all that surprising. And looking to the future, there's still plenty of room for growth even in their digital ad segment, given that the market is expected to reach over $500 billion in just a few years, with most of that value coming from search and social media, which are two areas that Google performs very well in, with Google Search and YouTube Video. Speaking of which, Google currently controls over 92% market share of the global search market, while Baidu, which is known as sort of the Google of China, comes in at barely above 1%. And even that's mostly due to the fact that Google isn't even really allowed in China, but given the circumstances of the trade war and the slowing down Chinese economy, that might actually be a good thing, as analysts would probably use it as ammunition to bring the stock down even further than it's already kind of dipped. All the meanwhile, Google is still trying to enter the Chinese market, and I'm not saying that they'll be successful in doing so, but if they are, that could be a huge boost to their sales, since China alone accounts for about $80 billion of the digital advertising market, with growth of 22% this year and about 70% of all media advertising going to digital, which is expected to increase in the coming years right along with the rest of the world. But all of this isn't even mentioning the fact that YouTube has already passed 2 billion monthly users this year. Chrome controls 63% of the global web browser market. Their Android mobile operating system controls an enormous 75% of the mobile OS market. Google Cloud only has less than 10% market share in the cloud computing market, but it's growing at an extremely fast rate, with sales jumping 25% this latest quarter in the segment that it operates in. They're also launching Google Stadia later this year to tackle the video game streaming market, and they even own Waymo, which is a big play on the autonomous vehicle and robotaxi markets that I often talk about in my other videos. And by the way, the slowdown in digital advertising was mostly due to currency movements and the timing of advertising product changes, which they mentioned during their conference call, can often have big impacts on year-over-year growth rates for specific quarters. I'm not saying you have to believe them, but if it's true, then that would add even more credence to this being an overblown reaction by investors towards a company that continuously grows their sales by over 20% a year, despite already doing well over $100 billion in revenue, and has nearly doubled their net income in just the past few years. Not to mention that they have one of the absolute best balance sheets out there, with current and total ratios of almost 4 each. That's over $100 billion in just cash and marketable securities that can easily fund future growth prospects or even a dividend, given how incredibly little debt they have. So give me an amazing stock like Google at a pretty nice discount just because they had 1 or 2 bumpy quarters, and I almost have to take that every time. I haven't purchased it yet, but I really do think that Google will soon be a core position of mine, because I really do believe in the company for the long term. Alright guys, moving on to stock number 3, we'll go with the high risk one here, at least in my opinion. It's a stock that a lot of you have been asking me to give an update on because they essentially lost like half of their value. And that stock is Nvidia, ticker symbol NVDA. And this is a stock that I own myself. I purchased it at the beginning of the year. It was very, very low at that time, so I'm actually still up on my position. But it was a small position. Since then, in 2019, the stock kind of started taking off, so I haven't really added to my position. But I think that we could continue to have some volatility here. I may add to it in small amounts, because I think towards the end of the year, they'll probably see a bottom and they'll start to recover. And so we're going to talk about all of that. Now, if you've never heard of Nvidia, they're mostly a graphics processing chip company. So think of like the GPUs that you use in your computers, but they're also a big play on autonomous driving, gaming, artificial intelligence, and of course the data center. Now, taking a look at the stock, we can see that they are still up over 700% in the past 5 years. So even with the recent tanking, early long-term investors don't really have anything to complain about. More recently, however, the stock has been beaten down due to the cryptocurrency crash that left many second-hand Nvidia GPU cards out in the market, basically meaning that crypto miners had stopped using these cards, so they decided to sell them, and that flooded the market with used cards, which led to lower sales for Nvidia and an overall devastating effect on their revenue. So much so that in just a few months, the stock literally dropped by 57% from their all-time high to their 52-week low. They've since seen a really nice recovery here in 2019, but ultimately came crashing back down this past month, leaving the stock at some pretty enticing levels with a forward PE ratio of just about 21. That may seem a little high given the recent struggles, but you can't forget that up until this year, Nvidia was a very high growth stock. Now, we mentioned the impact that cryptocurrency mining had on their sales, but I created a couple charts here to better illustrate the impact. Now, yearly numbers have still been pretty strong, as revenue climbed from $5 billion in 2015 to more than double that in 2018, and they still saw revenue growth of over 20% last year, despite already seeing some of their sales slow down because of cryptocurrencies. But profits have also been impressive, as net income climbed from just about $500 million in 2015 to over $4 billion in 2018, again still seeing strong growth even last year. But it's really been the last 2 quarters that have been devastating for Nvidia. As you can see here, I plotted down all of the last 8 quarters, and you can see a pretty big drop in sales in these last couple quarters. In fact, if we convert these numbers into year-over-year growth rates, you can see that they dropped from positive 40% in Q2 of 2018 to negative 30% in their latest quarter. So why then am I still bullish on Nvidia for the long term? Well, I think we might be starting to approach a bottom later this year. In fact, they actually beat estimates in their latest quarter on both the top and bottom line, and in the next quarter, they're guiding for $2.55 billion in revenue, which continues the upward quarterly trend despite still being in recovery mode from the crypto hangover. And while year-over-year growth is still negative, it's much smaller in the second quarter at 18% versus 31% the quarter before that. According to Nvidia, this is mostly due to their gaming segment reaching normalized levels between Q2 and Q3 as they normalize the channel inventory, basically meaning that crypto mining cards will eventually stop having a drag on sales. For context, their gaming segment alone was down about 40% in their latest quarter, so if it normalizes in the next couple of quarters, we should obviously see a really nice surge in sales. And while much of the poor performance is of course due to their newest Turing-based cards not being a big enough leap in performance to warrant the high price tags, as well as the weakening Chinese economy, which is, by the way, a large customer of Nvidia and one that they frequently use as a reason for declining sales, but most of the pain is still likely due to the enormous cryptocurrency crash. Of course, the whole trade war doesn't really help the situation, so any kind of trade deal would not only get rid of these extremely high tariffs, but it could also boost consumer confidence in China, leading to a strengthened economy, which would obviously benefit Nvidia, but who knows when that will be at this point. Now, going forward, Nvidia isn't providing guidance for the full year, and that's another alarming sight to me because it probably means that results could be worse than previously thought. However, the guidance that they previously gave for the full year called for sales being either flat or slightly down year over year. So as long as it's not extremely worse than that, then you'd have to assume that their sales will start to pick back up heavily towards the end of the year. And the good thing is that all of this negativity is currently being priced into the stock right now, so prices are likely to continue getting cheaper and cheaper throughout the year until they start to recover. And that's where I would like to do most of my buying as a shareholder. But I do still think that the market overall will continue to weaken in the short term because of the trade war, and I don't think Nvidia is going to be immune to that. So I'm definitely doing my buying very slowly and selectively where I see the most opportunity, and I think Nvidia will get there soon considering how much it's already crashed. And as a long-term investment, the story is still pretty much the same for Nvidia, which is ultimately growth in data center, artificial intelligence, gaming, and autonomous driving. By the way, in autonomous driving, there isn't really much competition out there, since the only chip that supposedly has better performance is Tesla's, which some analysts claim is a couple years ahead of anybody else, but that's their own in-house chip and platform. And if Tesla is truly so far ahead of all the competition in autonomous driving, I could see many vehicle companies wanting to ramp up their autonomous fleets, and the fastest way to do so would be to either adopt or continue using Nvidia's autonomous driving platform, which, by the way, ARK Invest estimates that the autonomous platform provider market will surpass $2 trillion in the next decade, and Nvidia stands to benefit heavily from that. Not to mention that most of the revenue still comes from gaming, and that market should be worth well over $150 billion by the end of this year. There's even rumors about a new Nintendo Switch being released soon, and that would be powered by Nvidia, so that could obviously boost their gaming revenues a bit further as well. So again, I still think that in the short term, there's a lot of risk to Nvidia because the whole trade war could just affect the whole market. And again, I don't think Nvidia will be immune to that. In fact, I think Nvidia could be hit pretty hard as a result of that. But if a trade deal gets done, that changes everything. And so far, we are already starting to see some improvements from Nvidia. And I think in the second half of the year is when Nvidia will really bottom out, and I think it'll start performing better, assuming that the market can kind of sustain it, if that makes sense. I hope I'm being clear about that. But anyway, that's kind of how I feel about Nvidia. I am looking to add to my position, but very slowly because I do still think it'll be very volatile throughout this year. Alright guys, that just about does it for this video. Make sure you hit the like button if you enjoyed it, subscribe if you haven't already, and if you want to see past episodes, of this monthly series, you can check those out down in the description, right up here, and at the end of this video on a clickable card, you can find the 3 stocks monthly playlist. But thank you so much for watching, for all the support. I really appreciate it, and I'll catch you guys in the next one. Take care. Bye-bye.